Hi YouTube, it's Janelle here. In this video, I'm going to be talking about the current stock market volatility, and I'm going to be talking about how I lost over $3,000 in the stock market. It's definitely something that can sting when it happens, but I'm also going to be talking in this video about how I really don't care that I lost those $3,000 and why I'm not letting it faze me or letting it affect me in any way on my day-to-day. So stay tuned for that. Really quickly before I jump into the video, I just want to remind everybody that I have a Patreon page linked in the description box below. You can go ahead over to my Patreon page and fund and support so that I can continue to put content right here up on my channel. I post videos every week sharing, different ideas, different opinions, different advice, tips, and things that I'm learning as I go along in my personal financial journey. I'm learning just as much as I'm sharing. So, I would love for you to join me for the ride. Definitely subscribe if you haven't subscribed to the channel already. And finally, go ahead over to my Instagram and Facebook and follow me, add me, like me, all that good stuff. Come over to the social media channels and show me love. I try to post as often as I can, and definitely love engaging with everybody who watches me here on YouTube. So now I'm going to go ahead and jump in talking about what is going on in the stock market. So this video was actually a request by a YouTuber named Supreme Obliterator. So Supreme Obliterator said 2 weeks ago, hey, MissBeHelpful, could I make a request? Could you talk about the current situation with the stock market? It's been going very high very quickly, and I wanted to know what you thought. A lot of people investing early in 2018 are trying to get on board. I think it has a future, but I think short term a pullback could happen. Maybe you could make a video and give your thoughts. Thanks. Okay, so I'm sorry it took a while. This comment was posted 2 weeks ago, and I'm just now getting to it. There's been so much up and down in the past, 2 weeks. So I'm sure, you have to be living under a rock if you don't know that, in the past 2 weeks, the stock market has been going crazy. It was really, really high, and then it went low and it started to go down a lot. Now in the past couple of days, it's been going up again. So it's just like a constant roller coaster ride. And honestly, in my opinion, what's going on with the stock market is not unlike what normally goes on with the stock market. Yes, right now it is a little bit overinflated than like the normal return that you might see from the stock market. But, honestly, the constant up and down is very typical of the stock market. So I want to kind of talk about that a little bit, and then I'll come back and talk about the specific details around how much money I lost and why I'm not going to freak out about it. So the first thing that I want to talk about is how stock prices are always going to change constantly and very often. So, sometimes the stock price can go, a certain specific stock price could go up and down multiple times in 1 minute. And so that's a lot of change, and that's really rapid. That's like a super fast kind of change. So again, that's why people say that the stock market is unstable and the stock market is volatile. Like, people constantly use all these words to, show how risky and how scary the stock market can be when you put your money in the stock market. But at the end of the day, I think it's really important to understand, why it is that the stock market prices are constantly going up and down very quickly or very erratically, so that you can understand a little bit more about why it happens and kind of, relax and chill when it does happen. You're not going to be freaking out because you actually have some sort of understanding around why it's happening, and what, might continue to happen over time. So when I first started investing in the stock market, I didn't really understand it. I just knew that it was important to start investing my money in places where I was going to get more of a return than I would get at a regular, bank account, like in a savings account or something like that, or even like in a CD. But I didn't really understand. And so when I would log into my robo-advising apps, I would see it was going down. I had less money than what I put in, and I started to freak out like, oh, no. Like, oh my God, I already lost $50 or I already lost $100. And you're kind of like, your gut instinct is to take the money, the little bit of money that you have left to take it out before you lose that too. That is the instinct that you have, your gut reaction, because people, naturally are very risk averse. We don't want to, lose money that we have, that we're putting in with the idea, with the hope that we're going to make it grow. Once you start to see that you're losing what you put in, that's when you start to get kind of a little bit freaked out. The reason why the prices are going to go up and down constantly is because of something called market forces. Market forces is just a fancy term, another way of saying supply and demand within the stock market. So it's just like, it's very easy to understand if you think about it this way. When demand for something is high, so when a specific stock is popular and a lot of people want it, the price is going to be high because there's a lot of demand for it. When demand is very low, nobody wants a stock, it's very unpopular, then the price is going to be very low. And that's it. That's literally why the price is going up and down. It's because either a stock is very popular or a stock is not popular. And that is literally the reason why it goes up and down. But why a stock becomes popular or why it might become unpopular, that becomes a little bit more complicated. And you know, the big reason why it's a little complicated is because it's all about people who are participating in the stock market and what their idea of that piece of stock is, or that company that the stock is for. So if they believe that the company has a lot of value, then if they think that in the future it's going to be worth more, then they're going to be willing to pay a lot more for it right now because they think it's going to be worth more in the future. But if people think a certain company does not have a lot of value, or it's not that popular, they really don't think that it's going to do better in the future than it's doing right now, then a lot of people aren't going to want to buy it. Demand's going to be very low and the price is going to be very low. And a lot of people kind of use different things, different reasons to make up their mind about whether they think a stock is worth money or not. And a big piece of it, honestly speaking, is just emotion. A lot of people just feel, they go with the flow of what the crowd is doing, right? It's like, if everybody thinks that Apple is hot, then I'm going to put my money on Apple. If everyone's buying Amazon stock, I'm going to buy Amazon stock. There's definitely this herd mentality when it comes to stocks, that a lot of people go and follow the masses and just go and purchase stocks that are popular. And so that kind of throws off the market a little bit because it makes it seem like a specific company has a lot of value, but that might not be necessarily the case. It might just be, it's just pretty popular right now. And so people who are starting to invest or new investors need to be very careful to not be swayed by, the masses, to just come up with a plan that matches your own investment philosophy, your own investment preferences, and just stick to that. Set your plan and forget your plan. Set it and forget it. Do not think about it. Don't look at it. I mean, you can look at it every now and then, but don't look at it every single day expecting to see, growth and to check and see if it's going up or down, because you're just going to stress yourself out and you're going to be really, frustrated whenever you see that the stock market is going down. So you want to not necessarily be, driving yourself crazy looking at it every day. When the market goes up, people call it a bull market. And that's because everybody's optimistic about it. It's going up and the trend is going upward. And I think it came from the fact that when a bull attacks you, the horns kind of get stabbed into you going upward. And so that motion is why it's called a bull market when it's going up. So it's been a bull market for quite some time now. And a lot of people have been talking about the stock market is doing really well. And then when it's not doing so well, so when it drops really fast and a lot of people are pessimistic about the trend, saying, uh-oh, this is going downward, this is not going in a good direction, then that's called a bear market. And it's called a bear market because when a bear attacks people, they attack with their paw, moving downward. So the downward motion represents the downward trend in the stock market. So that's just, lingo that's helpful to know whenever you're reading these articles about the stock market. If you're like, what are they talking about? Bulls, bears, bull investors, markets going up, down. I don't know what they're talking about. It's just really nice to have a basic understanding of what these things mean so that you know what's happening and you're not gonna freak out about any of these headlines. It's really important to not pay attention to a lot of the media out there because it's clickbait, it's trying to get people riled up. And then again, everybody starts to follow the masses and start to make decisions, that are different from their original plan that they set just because, either herd behavior or, FOMO, whatever. People just don't want to miss out on participating in the same thing everybody else was participating in. And so those are just not very smart reasons to move your money out of an investment that you plan to keep for a long time. So it just doesn't make sense. Set it and forget it. Leave your investments. Don't touch them for many, 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 many years. And if history repeats itself, if the data that we have about the stock market continues to replicate the way that it's been behaving for the past few decades, then the market is going to keep going up and your return is going to come back higher after a few decades. But you just have to be patient, and you have to not take it out. You have to not touch it. You have to not pay attention to people's comments about take it out, don't invest in this, don't invest in that. Just don't pay attention to it. Stick to your plan. Leave it in there. Now, a really good way for new investors to find out what, sort of philosophy they have or how they feel about investing and what they should be kind of thinking about is by asking two really simple questions. And I learned these questions probably a year ago. And ever since I did, I changed my entire portfolio allocation. And I'm so happy I did, because now I just did the set it and forget it. And now I'm not worried as much about it, which is why I'm not freaking out, even though I lost a lot of money in the stock market just last week. So the two questions are, first, what are your individual goals for your money? Thinking about how long you want to keep that money in there. So if your individual goal is to leave that money in there for 5 years and watch it grow, that's different from somebody whose individual goal might be to leave the money in there for 15 years. And the way that you create that individual goal is you think about, how long can you afford to keep that money invested before you're going to actually need the money. So you have to think about, okay, how long can this money stay invested before I need it? And for me, the way that I've set up my financial situation, I really don't need any money that I'm putting in the stock market. All of the pennies and dollars that I'm putting in the stock market, I'm leaving in there for the long term. I'm leaving them in there for 20, 30 years. I've decided I don't need that. Well, I didn't just decide I don't need that money. I made a plan to make sure that I don't need that money. So when I do need money in case of an emergency, something crazy happens, I have my emergency fund, and I, have money in my checkings account for my everyday or day-to-day expenses. So if something was to come up unexpected and it's a small thing, I would use, the money in my checkings account to just handle it. If it was a really big emergency, required a little bit more than just a day-to-day expense, then I would use the money in my emergency fund, and I should be okay with that, right? For me, I've made a plan where my emergency fund should be able to cover me for the next 6 to 8 months of, rent, food, and bills. So once you're in that situation and you're a really good place where your debt is paid off and you have that, cushion, that's when it's a really good opportunity for you, a good time for you to just start putting all the rest of the money that you would normally be saving in your savings account, start putting that in an investment account. So that's what I've been doing for the past 2 years. I've been putting half of my income into the stock market. And I think I almost put like $30,000 for my Betterment account. And I've been talking a lot on my channel about how I really like Betterment. I've had it for probably about 2 years, a year and a half, maybe almost 2 years. And the amount of money that I put in there has really grown. So that's simply because of the fact that I put a very high percentage of it in stocks and a very low percentage of it in bonds. And then I left it alone and I didn't touch it. And, recently it's gotten grown a lot, which is really good because I'm not really touching it and I really don't want to touch it for a long time. But it's really important that you have to answer that question. Are you able to leave that money in there for a really long time without touching it, and you won't actually need it or depend on that money? So if you know that you're going to need the money really soon, then that's not money you should put in the stock market. That's first and foremost. And then the second question is, are you able to handle the psychological sting of the market going up and down constantly for the whole time that you're going to leave the money in there? Once you kind of put the money in the stock market, what ends up happening to it shouldn't really matter to you because you've decided that you're going to be in it for the long term. If you're the kind of investor who's putting money in, trying to get a really quick buck and then take it out and then put it in, get another return and then take it out, I definitely do not invest that way, and I don't recommend investing that way because it's just so high stress. There's definitely better ways for you to get a very similar return without having to constantly be stressed out about checking the market and looking and pulling the money out before you lose it and all that kind of stressful stuff. So for me, that means, I don't necessarily check my Betterment account all the time, but on January 29th, I did happen to log in and check it. And when I did, I was like, oh, let me just look at, how much I have and like, take a look at my account, how it's been doing. Because I hadn't looked at it since, at all in 2018 yet. So January 29th, that's, almost a month into the new year. I logged into my Betterment account and I noticed that my, it's not $30,000 yet. I think I have in there like $26,000, maybe a little bit more than $26,000. And it had been in there for 2 years. And it was at a return rate of 31.6%. And that's a simple return. So that's for the whole time that it's been in there, it's averaged a 31.6% return, which is pretty awesome because from the $26,200 that I put in, I got back on top of that $8,293.80. And that was just in, the profit that I made, the 31.6% return. That is really high. But again, I had my allocation set for 97% stocks and 3% bonds. So almost all of the money that I put in, almost all the $26,000 was in stocks. And I did that on purpose because I'm really young right now. I don't have to worry about, using this money or needing this money anytime soon. I know I want to put this money in here so that when I retire, I can take it out and, benefit from a lot of return over the years. So I'm not really worried about it right now. And that's a really important thing to just accept that it doesn't matter how much it's going up or down. You are not going to touch it for however many years. And so again, I monitor it. So I look at it every now and then. And a couple of days after that, so like the first week of February, that's when everybody was talking about the Dow Jones and S&P 500 had dropped so much. The stock market had dropped so many points, had dropped such a high percentage, and people were kind of talking about it and it was buzzing. So I was just curious and I logged in again on February 9th. On February 9th, which is exactly 14 days after I saw the account was at 31.6%, the account had dropped down to 19.3% return. Ouch. So out of the $26,200 that I put in, the return back that I got was $5,047.81. So I lost $3,235.99 in 14 days. Now that is a lot of money. And, again, the mental sting kind of did happen. I'm not going to pretend that I was like, no, well, I lost $3,000. No biggie. Like, of course I was like, oh man, what happened? Like I was just like, I was nervous. I was looking at it like, oh man, this sucks, right? But once I kind of looked and swiped through and saw, which specific, parts of my portfolio had dropped, which specific, stocks had gone down and which ones were performing poorly, I was like, oh, okay. Like, I guess at least I see what's going on. And then that was it. I exited the app. And I went about my business. I went about my normal every single day life and I did not worry. I wasn't stressed. I was not fazed. I did not care because again, I've already made up my mind that this is this doesn't matter right now. This is for the long term. And I can't stress that enough. I feel like a broken record, keep saying that, but I think it's so important because too many people see the money that they put in go down and they just immediately want to take it out. They start freaking out and they don't want it to go down. They don't want to lose any more money. So they think taking it out is going to be a good idea, but it's just not. You're going to end up paying taxes because you pulled it out so quickly. So it's going to be a short-term capital gain instead of a long-term capital gain. And when you pay taxes, short-term capital gains, which is an investment that you put in for a short period of time and then took it out, those get taxed much higher because the government wants to incentivize you for leaving it in longer. So that's why they charge you less taxes on long-term capital gains. So it's much better to leave it in long-term so that you can pay less taxes. But a lot of people don't think about that. They don't account for that. And then they just pull it out in the short term. And they end up losing more money than if they were to just leave it in there and ride it out and wait for the market to go back to normal. So that's why I didn't really care. I know, it kind of stung a little bit when I lost the $3,000, but I didn't really care. And then Valentine's Day, I checked my account again, just again out of curiosity because a lot of articles were coming out about how the market was going up. And I was like, oh, just out of curiosity, I'm not going to take the money out. I'm not going to touch it, but I just want to see. So I logged in at my account and I saw it was up again to 22.2%. So from 19, it went back up to 22. So it goes down, it goes up a little bit. Probably it's going to go down again a lot because let's be real, the market is pretty overinflated right now. So it's probably going to go down again soon. But again, I'm just curious to see what's happening. I'm not doing anything about it. I'm not going to take any money out. I'm not going to move it around. I'm not going to change anything. I've already answered those 2 questions for myself that I mentioned earlier, which is, how long can you leave the money in there invested without needing it, which for me is as long as until I retire. And then the second question was, can you handle the mental and psychological sting every time it goes down? And for me, it's yes. I mean, yes, I have little reactions here and there, but I'm not going to do anything about it. I'm not going to take action. It's just, information that I can see, updates that I get, and I move on with my life and don't pay attention to it. I just act like, oh, well, nothing happened. It's not anything that I'm going to do anything about. And then the last thing that I'll say about the stock market is that it doesn't really affect us on a day-to-day basis. Besides, the bits of money that I talked about going up and down, losing that's not a lot of my net worth. Most of my net worth is going to be, well, not most of it, but a lot of my net worth is going to be in my bank account because I want to make sure that I have enough money to hold me down for the next 6 to 8 months. So I know that a lot of my money is going to be there. A lot of my money from my net worth is also in my Roth IRA, my traditional IRA, and the retirement accounts that I have. And then I have the rest, of the money in the stock market because I do want a big chunk of my money to be in the stock market while I'm young so I can benefit from compound interest over time. But it's not smart to put all of your money in the stock market because when things aren't looking good, if you do have an emergency, you need the money, it's locked in the stock market and you can't really necessarily touch it, or it's decreased so much in value that you lost so much of your money. So you don't want to ever be in a position where you put all of the money that you have in the stock market waiting for it to grow so much. You want to, be smarter about the way you split up your money. And you're not really going to be affected if you do it that way. The people who are really affected are like the super, super rich people who have like all of their money in the stock market. I mean, I think I read somewhere like 90% of the stock market is controlled or owned by just 10% of Americans, which means that 10%, the highest, paid or just even not even the highest paid, but the wealthiest 10% of Americans are the ones who really run and manage and own and, move 90% of the market. So that's most of the money there. So when the market goes up and down, drops from 30% to 19% in 14 days, those top maybe 500 wealthiest people who are invested in the stock market are losing hundreds of billions of dollars. So yeah, they're tight, they're upset, they're mad, they are freaking out. But average everyday people like me, like it's not really going to affect people like us. Like unless you have a lot of money accumulated over time, it's really not going to affect you that much on a day-to-day basis. So it's not the kind of thing you should let stress you out. If you're really close to retirement age, then of course this is going to affect you more than a young person or a younger person. So definitely just make sure that every few years you're going into your account and you're adjusting your allocation so that you're not 97% stocks, when you want to retire in a year. By the time you're ready to retire, you should have more money in bonds and way less money in stocks because the type of investments that you want to be making are way less risky as you get closer to retirement age. You want your money to be available for you when you need to retire, when you need to take it out and use it. So definitely pay attention to that. If you're older and you're closer to retirement age, you want your allocation to be, a lot more sensible, a lot more, basically ready to prepare you to retire sooner rather than later. So just paying attention to all of those things. I know I talked a lot and I said a lot about the stock market and a lot about different allocation percentages and things like that. So if you have questions about any of the things that I mentioned in this video, definitely go ahead and put them in the comments below and I'll definitely reach out and answer them. If you have any specific questions that are personal to any situation that you have and you don't want to put them in the comments, you can always email them to me at MissBeHelpful@gmail.com. Don't forget to subscribe to the channel. And that's all I have for you guys. Till next time, peace.